Today, more details emerge regarding BlockFi's bankruptcy. JPMorgan predicts centralized crypto exchanges will stay dominant despite FTX's collapse. And BitGo CEO Mike Belshe discusses the company's custody of FTX assets. Welcome to CNBC's Crypto World. I'm Tanea McKeel. Crypto trading higher this morning, recouping some of yesterday's losses that followed BlockFi filing for bankruptcy protection. As of noon Eastern, Bitcoin traded around $16,500, where it's held fairly steady in recent days. At the same time, Ether rose to $1,200 and Polygon traded around 83 cents. Okay, let's talk about the top stories. First, we're learning more about what prompted BlockFi's bankruptcy. In a 41-page court filing, BlockFi advisor Mark Renzi said the company's Chapter 11 bankruptcy troubles began with FTX and a liquidity injection that was supposed to save the firm. Over the summer, FTX swooped in to help BlockFi prevent bankruptcy by extending $400 million in revolving credit. It also offered to potentially buy the troubled lender after the implosion of Three Arrows Capital. Renzi put most of the blame on exposure to the bankrupt crypto hedge fund as well as FTX and broader market uncertainty. He wrote that BlockFi is, quote, well-positioned to move forward despite the fact that 2022 has been a uniquely terrible year for the cryptocurrency industry. On the day FTX filed for bankruptcy, BlockFi paused customer withdrawals. Now, customers at FTX, Voyager, and Celsius are left wondering if they will ever be able to access their funds again. In the filing, BlockFi indicated that it had more than 100,000 creditors with liabilities and assets ranging from $1 to $10 billion. Bloomberg reported that the SEC is one of the biggest creditors to BlockFi, with a $30 million unsecured claim against the crypto lender, citing a Monday filing. The SEC declined to comment. Next up, days before FTX collapsed, Sam Bankman-Fried allegedly pledged Robinhood shares to BlockFi as collateral. Now, the Financial Times is reporting that BlockFi is suing SBF to seize those shares. On the same day BlockFi filed for bankruptcy protection, the crypto lender sued SBF's Emergent Fidelity Technologies holding company for those promised Robinhood shares. According to this complaint, BlockFi entered an agreement with Emergent earlier this month to guarantee payment, pledging an unnamed common stock as collateral. Citing loan documents, the Financial Times reported that the borrower was SBF's trading house Alameda Research, and the collateral at issue is SBF's stake in Robinhood. The Financial Times previously reported that earlier this month, ahead of FTX's bankruptcy filing, SBF had been privately trying to sell Robinhood shares. BlockFi and SBF did not immediately respond to our request for comment. And finally, centralized crypto exchanges will stay dominant despite the fall of FTX, and that's according to JPMorgan strategists. A note sent to clients on Thursday said issues like slower transaction speeds will likely limit institutional participation in decentralized exchanges, or DEXs. Analysts also noted DeFi's vulnerability to hacks and other risks associated with DEXs would limit widespread adoption. The team wrote that the management, governance, and auditing of DeFi protocols without compromising too much on security and centralization is a, quote, big challenge. JPMorgan acknowledged the recent uptick in trading volume for decentralized exchanges since the fall of FTX, but suggested it does not believe this trend will last long term. The analyst noted that the shift more likely reflects the collapse in crypto prices and the deleveraging and automatic liquidations that followed the FTX collapse. All right, on to our main story. BitGo, the crypto custodial company hired by FTX after it filed for bankruptcy, disclosed last week in court filings how much it recovered in FTX assets so far. BitGo estimates that the amount of recovered and secured assets has likely increased above $1 billion since November 16th, when that number was $740 million. Today, I spoke with Mike Belshe, the CEO of BitGo, about how the company is helping FTX protect its remaining assets and what the industry needs to do to get back on its feet.
I want to start with FTX more narrowly. John Ray, the new CEO of FTX, his team called you pretty quickly, I gather, after the big event this month to be able to secure FTX assets. What can you share with us about that?
Well, thanks for having me. Let's see. In order to answer the question, I want to make sure I abide by kind of what they have public for us. But yeah, we have a new team that came in and was looking to identify where the assets are and make sure they can protect them. And they called BitGo to help. As John has stated publicly, there were a lot of controls missing that you would normally expect at FTX in terms of operational financial security controls. And so I think the new management team was looking to quickly work with somebody they knew that they could trust, that would be able to kind of take these assets and get them out of danger, you might say. So BitGo's had a long-standing relationship with LedgerX. I think dating back 2015, 2016, LedgerX was acquired by FTX US and became FTX US Derivatives. So we've been providing custody there for a long time. They're CFTC regulated, and CFTC of course has been inquiring with them for the last few weeks to see how things are going, and they've been passing that with flying colors. And that's because they took the time to build the right structure and make sure they had the right checks and balances in place. And BitGo was a part of that. So when FTX larger started to look for how are they going to move forward, BitGo, I think, was a fairly easy choice for them.
And you at BitGo had previously estimated that the amount of recovered and secured assets had likely increased above $1 billion since November 16th. At that point, the number was $740 million. Is that still accurate, or has more been recovered by this point?
Well, you can see a lot with the on-chain addresses. So there's a lot of Twitter sleuthing that's going into what's been recovered. I'll let John and the new management team kind of share kind of their progress as it goes forward. My guess is that yes, they will recover more assets. How deep that goes, the John Ray and his management team probably have better insight than I do.
And you said in your previous answer, I think you said the phrase "getting those assets out of danger." What exactly, if you could explain, is the significance of BitGo working with FTX now for viewers and investors that might not quite understand the business of custody? What do you bring to the table here, and how are you helping FTX through this bankruptcy process?
Sure. Well, Sam Bankman-Fried and his team, clearly orchestrated a very large fraud. So they've been acting in a criminal manner, and regardless of how they portray it to be, it's unclear to anyone, new management, regulators, authorities, investigators, investors, exactly what their intentions are next. So when you're using independent custody, we can help safeguard those assets away from the old management team. But if you're not using independent custody, then actually the holders of those assets are the old management team. So remember, they had self-custody internally, which means that the old management team, which had already been booted out by the time BitGo got called, still could potentially have access to those assets. There was some sort of a hack or movement going on a couple of different occasions, and that was unbeknownst to the new management team. So who's orchestrating that? How is that happening? So they needed to move the assets into safety, and that's where BitGo came in.
What has been sort of the biggest takeaway from this event for you? Whether on the institution side, the individual investor side, the lessons we've learned about regulation. What has been the biggest takeaway for you about, from this blow up at FTX and the various choices and mistakes that led up to it?
Well, BitGo's been advocating the creation of market structure for 4 or 5 years now. And our first step has been okay, well, let's create a separation of trading activity away from custody. Custody has a particular set of expertise. It provides a level of check and balances to those that are trading, et cetera. The takeaway for me is actually we have not been aggressive as a company, as an ecosystem, as we need to be in order to keep investors safe. Really the premise of digital assets is that you shouldn't have to rely on trust in order to have your assets be safe. And yet, here we had a tremendous amount of trust on a particular entity who turned out to not be worthy of that trust. We have to eliminate this faster than we've been working on it so far. So I hope that the industry can come together right now and start really getting serious about how do we provide bankruptcy protection all the way down to the end client of exchanges today. Regulators are going to come in. They're going to make some changes. I'm certain of that. I think that will push us in some direction. But I think also industry has to move faster here if we want to avoid having another, kind of bankruptcy type failure.
Final thing for me, what can companies do in the interim as we're waiting for more regulatory clarity?
Well, on regulatory clarity, usually that's referring to what's a security and what's not a security. I don't think that really was an issue here. What we had here is a failure of the infrastructure components to not have appropriate checks and balances. We do know how to build appropriate checks and balances, and I think investors that are investing heavily in the space need to just look for those until they're mandated. And I mean, it means you need to do more diligence. And if you're not ready to do the diligence, maybe you should be on the sidelines a little bit longer.
Okay, that's all for Crypto World today, but we'll be back again tomorrow, so we'll see you then.